the case for separating your politics from your investments in this week's fastest 4 minutes in finance. Hello, thanks for watching. I'm Scott Inman. Well, we can't completely remove bias from our investment behavior. Most of us have a political persuasion, even if it's independent. And we sometimes think that if our candidate or party is in power, the economy and the market will do well. And if the other candidate or party is in office, the reverse is true. As we've pointed out numerous times in this series, though, that is not a good way to make investment decisions. As the midterm election draws closer, we are about to be swamped with political ads hitting our TV, radio, and social media pages, and the messages will range from negative to outright dire. Candidates, political parties, and special interest groups will spend millions trying to convince voters that if they make the wrong choice in the voting booth, the world as we know it will end. Well, the political fight and the uncertainty over election results is likely to impact your investments. But it is also likely to be short-lived, regardless of who wins and loses. Take a look at this chart from LPL Research. These are the historic returns of the S&P 500 index in each year of a president's first term. While the long-term averages are positive in all 4 years, the worst performance is in a midterm election year, where it gains just 4.6% on average. These years also typically have the most volatility and the biggest average max drawdown of 17.5%. But let's focus on year 3. In the year after a midterm election, the index is up on average 14.3%, with the lowest average max drawdown of 11.2%. In fact, the S&P 500 index has risen during the 12 months following midterm elections 18 straight times, all the way back to 1954. The pattern here is clear. Political uncertainty peaks ahead of an election and begins to fade once the outcome is known, and that's regardless of the winners and losers. So this time around, LPL Research has a base case that the outcome of the midterm is a split Congress, and that can be a good thing for the stock market. A divided Congress suggests gridlock. Radical change, not likely. At the same time, it could create more volatility around key issues like government funding and the debt ceiling, and it could shift emphasis on policy decisions back to the executive branch. Bottom line, though, for investors is to stay focused on fundamentals and not headlines. The economic environment remains unchanged by politics. We continue to see resilient economic growth, strong AI-driven capital investment, and continued earnings expansion. Those things matter most for your investments, despite what any doomsday political ad may soon claim.
Want to become smarter financially in 4 minutes or less? Sign up at fastest4.com to get insights and updates like this delivered to your inbox weekly.